Another great quote for real estate investors specifically is, if you don't find a way to make money while you sleep, you'll have to work until you die. So Buffett makes money while he sleeps. How does he do it? Well, he's got 28 people in his corporate headquarters, but he's number 7, last I checked, in the Fortune 500. Think about that. 28 people he manages, and he doesn't even manage them really. But he's got thousands and thousands and tens of thousands of people working. He is like, in my mind, sort of like a fund of funds in real estate. He takes money from investors and then he invests it in all these deals, but someone else is doing the heavy lifting on those deals all over the country while he's sleeping, while he's awake, while he's on vacation. And this is what real estate is perfectly suited for.
Welcome to the Physicians and Properties Podcast, the show where we teach you how investing in real estate can give you the freedom to practice medicine and live life how you want.
Doctor! 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 Doctor!
Now, here's your host, Dr. Alex Schlow.
Hello, everyone. Welcome to another episode of the Physicians and Properties Podcast with your host, as always, Dr. Alex Schlow. Today, we have a repeat guest. The first repeat guest on the Physicians and Properties Podcast is none other than Paul Moore. This episode is a little bit different than our typical episode. This is less of an interview and more of Paul giving us so much knowledge and wisdom. We talk about Warren Buffett's principles for real estate investing. Paul goes through some incredibly popular Warren Buffett quotes and principles for financing and investing and how we can relate those to real estate investing. He makes those really practical, really understanding, and you're going to gain so much by watching this episode on YouTube, ideally, so you can see the PowerPoint slides, or just listening to it like a typical podcast. This was a great episode. I learned so much from this podcast, and I always learn so much when I have the opportunity to talk to Paul Moore, and I'm so grateful for his time. So without any further ado, let's get started with today's episode with Paul Moore. Paul Moore, welcome back to the Physicians and Properties Podcast. I'm so glad you're here, and I'm so happy to say you are the first repeat guest on the show. So excited for tonight and excited to learn from you yet again. Thanks for making the time and staying up late there in Virginia to have this conversation. I appreciate it.
Alex, what an honor to be here again. Thank you so much. I'm excited to talk to you and the audience tonight.
Well, me too. A lot of wisdom shared in the first podcast episode, so everyone go back and check that out. This one is going to be a little bit more tactical, focused on the man himself, Warren Buffett. So really excited to hear Warren Buffett's principles of real estate investing. This is going to be more presentation-based, so if you're not watching this on YouTube and you want to see the slides, head over to YouTube and check it out. So without any further ado, let's get started with my friend Paul Moore.
Right. Well, Alex, like you said a moment ago, I wrote a couple books. The first one actually was a local book about Virginia real estate, but then the second one was called The Perfect Investment, about multifamily investing. And I learned something really critical in this process, and that is this. The perfect investment is not perfect if you have to overpay, over-leverage, if you have to use risky floating rate debt, and if you have to assume trees will grow to the sky, in other words, that rents will continue to grow in sometimes double-digit fashion forever. And so I went on lots of podcasts a couple of years after I wrote this book, and I basically said, time out. It's not perfect. So I had to learn a lot of lessons along the way. And so I think I mentioned this in a previous show. I had a podcast called How to Lose Money for Years. And on that podcast, we talked about faults and foibles and mistakes we made along the way. And I learned a lot from Warren Buffett. I like to say Warren Buffett is my real estate mentor. Of course, he's never heard of me and he doesn't do real estate. But he has taught us so much about real estate investing, even though he's not a real estate investor. Just as a reminder for the audience, his track record is a little bit impressive. He started investing about 11. He amassed a large amount of money by 16. He's had a total gain of 3.6 million%. And just to put that in perspective, if you would have invested $100 when I was 2 years old, it'd be worth $3.6 million today. You can only fantasize about that, right, Alex?
That would be amazing.
Yeah. But his compound annual gain is 20% a year. People pay millions to have lunch with him annually. Most of his net worth, most of his wealth was amassed after 60 years old, about 95% or more for those who are listening. He's really boring. He's not really boring him like the way he speaks, but his life is boring. And that's why I love talking about becoming a boring investor, because he and Charlie Munger their lives were given to the most boring of pursuits, reading for hours and hours and hours a day. And Buffett, he reads like 5 newspapers a day, he leaves his phone off, he reads annual reports all day, and he's done a little well for himself, considering the fact that Berkshire Hathaway stock could drop 99% and still beat the S&P 500 by something like 30 or 40% over the last 56 years. So pretty amazing track record. Today, whenever you're listening to this, we're going to be talking about some of Warren Buffett's principles for real estate investors. So let's start by what's arguably, and I mean arguably, literally, his most famous saying, because there's a couple that are considered his most famous. One is, be greedy when others are fearful, and fearful when others are greedy. During the great financial crisis, Buffett made some investments that illustrate that he really believes this. For example, he invested in Bank of America and Goldman Sachs when no one else would touch them with a 39.5-foot pole. He made very successful investments when everybody was running for the exits. In fact, he invested $5 billion in Goldman Sachs, and then he did I think it was like a full-page newspaper editorial in the New York Times talking about why he did that. But he didn't invest in just common equity. He invested in preferred equity. And he was kind of my role model for us, our company, Wellings Capital, doing preferred equity investments in the last year or two. There's really good news, though. You don't have to predict the next market downturn to profit by it. And here's why. There's no crystal balls. Nobody can see a market downturn except in a rearview mirror. Nobody can see the bottom, at least, except in a rearview mirror. So what we need to do is act appropriately for where we are. We act consistently. We act appropriately. We invest as if there could be a huge uptick or a downturn at any time. And we don't take risks that are based on things we can't control. Who can control a pandemic? Who could have guessed the sharpness of the interest rate increases we've seen? So rather than try to predict the next downturn or upturn or anything else, we just do 3 things really well. And I'm saying we collectively, you, me, any great investor. And we learned this from Buffett, though. Number 1, we invest in durable assets. So Buffett always talks about that. And we consider that in real estate, recession-resistant commercial real estate. Durable assets. Second, we work with great managers. And so for Buffett, that would be hiring a great management team. Like when he invested in Apple, he was investing in their management team and their assets. And then third, he tries to buy when the value is far below the price. He said, price is what you pay, value is what you get. And we can think the same way in real estate. Those are some of the principles we've learned from Mr. Buffett. What are some other principles for real estate investors? Well, first of all, we ask the question, where are we now in the market cycle? We don't try to guess where the top will be. Peter Lynch from Fidelity Magellan fame said, those who live by a crystal ball are destined to eat glass. And we don't want to do that. We just try to figure out where we are now. We try to be prepared. And one of the ways to be prepared is to stick to your principles, is to actually study people who have made crazy contrarian decisions. And like when Burlington Northern Railroad was incredibly out of favor in 2007, Buffett bought all he could. In fact, I think he eventually bought the whole thing. Berkshire Hathaway bought the whole company, And that's when railroads were incredibly out of favor, but he saw intrinsic value. He bought Apple when Steve Jobs had passed away at $13 to $15 a share, and now it's worth a massive, massive amount more than that. It's critical to just be a contrarian, which takes a lot of courage. It doesn't take IQ as much as it takes courage to go against the crowd. Some practical tactics for real estate investors. It's important not to get wrapped up in comparing yourself to others in your network. One of the things that happened to me after I wrote The Perfect Investment is I got into a mastermind group with 9 other really successful multifamily investors. And they would come on these monthly calls. Yeah, I made $3 million the other day cashing out this deal. And I made this much on that deal. And here's the thing. We sat on the sidelines for almost that whole time because we weren't willing to take the risks that some of those folks did. And one of them on a recent mastermind call said, there's nothing in the world that would ever convince me to use risky floating rate debt again, because now all those millions, now they're like hurting and their investors are mad at them. I'm not saying we did the right thing. We passed on a lot of stuff, but it's because we didn't know when there'd be a downturn and we weren't willing to take those risks. So Buffett's most famous saying, be greedy when others are fearful and fearful when others are greedy. Any thoughts on that, Alex?
Paul, I love that. And I think that ties into your previous episode that we did together when you were talking about some of the risks that you made and how that worked out in your favor long-term and all that you learned from that. So again, encourage folks to listen to that episode. But some things that I think are really interesting is one that Buffett made about 95% of his wealth after the age of 60. And I know a lot of people that listen to the podcast are docs who have been practicing for a long time and they feel like, hey, I've gotten really behind in terms of investing, or is it really worth it for me to start right now? And I think that the perfect example, 95% of his wealth happened after the age of 60. So now is the time to start. The best time to invest in real estate was 10 years ago. The next best time is right now. And the same way, the same thing applies to Buffett here. And again, I love the 80% of his day reading. I am a huge reader and I would love to spend 80% of my day reading. And I know you and I have that connection and have shared some book recommendations. And so I love that. That sets Buffett up so well for his investing because he's reading all the best minds and reading so much about the different markets and all these different newspapers. And he's really attuned to what's going on in the market and how he can make these asymmetric bets and really succeed. I mean, it's just absolutely incredible what he's done and how I feel like he's greedy when others are fearful, but he's well informed and well educated. And he knows, hey, I'm making this asymmetric bet, but I'm Warren Buffett. It's going to work out. And so it's really cool to see that. I love the principles and how they relate to real estate investing as well.
Excellent. Well, great stuff. Those are great thoughts. And I know that a lot of us, including me, have been behind. I mean, honestly, because I took so many gambles that I'm not proud of now at all. In my 30s and 40s, I had to start over a bunch of times. But actually, those painful lessons helped me a lot through my 50s to be extremely conservative and to realize the difference between speculating and investing. Investing is when your principal is generally protected and you've got a chance to make a return. Speculating is when your principal is not safe at all and you've got a chance to make a return. And there's a big difference.
Yeah, absolutely.
So Mr. Buffett said, only when the tide goes out do you discover who's been swimming naked. And the context for this is a rising tide lifts all boats. But then Buffett comments, only when the tide goes out do you discover who's been swimming naked. Now, the crazy thing about this is that in commercial real estate, there's a lot of new ruse. And what I mean by that is these are new investors who are now touting themselves as gurus. And a lot of wealth was created through people listening to them because of the rising tide. It was really hard to tell the difference between an expert and an amateur over these last 13 or so years, since around 2011 to now. It was hard to know. In fact, here's the crazy thing. Alex, have you ever thought of this? The people who took the biggest risks made out the best. Here's an example. Let's say a multifamily investor, a syndicator, takes a 50% leverage because he's not sure about what the economy will do. He doesn't want to over leverage. He knows he had to pay a lot to get this multifamily, so he takes 50% debt and 50% equity. That person, honestly, has probably got a lot of experience. But another young person comes in and goes, I can make the most money for me and my investors by taking, if they could get it, 80% leverage. Well, think about it. When that property that he bought, they each bought for 10 million, sells for, let's say, 12 million, the person with 80% leverage made over double the profit on equity that the person with the 50% leverage took. Both of them did really well when they flipped that property in 2 years from 2018 to 2020, let's say. But the person with the high leverage looked better. And so people flocked to them and threw more money at them. The problem is those are often the amateurs. Again, what I call nurus. And these folks got a lot of applause. I was at a conference last week where a lot of people who were really, really well loved and well invested in over the last 7 or 8 years were there. And a few of them told me privately, I'm going through such a hard time. My investors are mad at me. We're losing money. These floating rate debt killed us. And then they said this. They said, but nobody could have predicted that. Everybody used floating rate debt. And, Alex, I'm not down on those guys, but that's not true. Mm-hmm. Lots of people predicted it, and lots of people didn't use floating rate debt. You don't have to go with the crowd. My mentor confessed to me 2 weeks ago that after preaching for fixed rate debt and against floating rate debt for like a decade, he actually did 3 or 4 deals that had floating rate debt. And now he said he looks stupid. Anyway, that's a lot of detail, but you get the point. What's the purpose and cost of insurance? Think about it. Why do we buy insurance? We buy insurance in good times for things that could happen in a bad time. It's a risk mitigation tool. And that guy who used the 50% leverage was basically buying insurance. You see what I mean? Yeah. And so the person with the 80% leverage didn't have much insurance. And when things went bad, when that hurricane hit, it went really bad for him. Another Buffett quote that's related to this one, he said, over the years, a number of very smart people have learned the hard way that a long string of impressive numbers multiplied by one single zero always equals 0. And so a lot of us that had to start over in our 30s or 40s learned that. I have to admit, I was one of those folks. Buffett has about $157 billion in insurance. And I don't mean that literally. I mean in the form of cash. Really, it's treasuries. He keeps, even when treasuries were paying almost nothing, he had 120, 130, 150 billion dollars in cash. And him doing that basically meant that he was keeping an insurance policy for when things go the opposite direction. He's got reserves to handle it, first of all, but secondly, he's actually got cash to buy when everybody else is selling. So, comments, Alex?
Another great quote by Buffett. And I completely agree. I feel like, correct me if I'm wrong, Paul, because you're a lot more in the commercial real estate space, but I feel like we're at a time right now where we're getting close to where cash is king. And a lot of these deal opportunities are coming up that did have that floating rate debt or that bridge debt, and they're having to sell for pennies on the dollar. And the people who are going to be able to scoop up those deals are going to be the folks that had that insurance policy, that had the equity, that had the cash ready to pounce.
What we're seeing right now, Alex, is it's not like 2008. And the reason is in 2008, I mean, it was so bad, and there's nothing like that happening really now. But in 2008, people in Florida were buying for 40. The average, from what I heard, was a 55% real estate drop. That means the really, really distressed ones might have dropped, like you said, 80% or whatever. And people got incredible deals. Unfortunately, well, I shouldn't say unfortunately, but they're not seeing as many good deals this time. But the principle is still true. There are opportunities now that people have not seen in years. You're absolutely right.
I feel like commercial lending has certainly tightened up a little bit as well, too. So you're having to put a larger percentage down, especially if you're just getting started in the commercial real estate space. So having the cash, and it's protecting the bank, but it's also protecting you from an equity perspective, as you mentioned.
Absolutely. So my next slide is about margin of safety. This is a long quote. For those listening, Mr. Buffett says, we insist on a margin of safety in our purchase price. If we calculate the value of a common stock to be only slightly higher than its price, we're not interested in buying. We believe this margin of safety principle, emphasized by his mentor, Benjamin Graham, to be the cornerstone of investment success. So what is a margin of safety? It's really simple. It's the delta, it's the difference between revenues and expenses. And specifically, I think the best way to measure it in real estate is the debt service coverage ratio. So here's how you calculate that. The debt service coverage ratio is the net operating income after you take expenses out compared to your debt payment. Okay, so if your debt payment is $10,000 a month, and your net revenues after your operating expenses are $11,000 a month, well, that is a really, really bad margin of safety. In fact, banks would not be happy with you at all if you had a 10% margin of safety. That'd be a 1.1 debt service coverage ratio. It's okay to have that temporarily if you have very significant value adds and opportunities to increase it. And the banks may tolerate that. I mean, think about it. Developers have that all the time. They don't have any revenues coming in. So there has to be a place for that. But it's basically not something that the margin of safety, that debt service coverage ratio is critical to have at 20, 25, 30, 50, 80, 100% even. A lot of our deals we invest in have about 100% margin of safety, meaning that the revenues, the net revenues after expenses are double the debt service, which is the principal and interest on the debt. I went to engineering school, believe it or not, and I was really irritated with some of the principles we learned. We learned that the margin of safety was also called a safety factor, needed to be like 3.2 for a bridge. I'm like, why? If there's a bridge with a 100,000-pound limit, why do you have to build it and engineer it to withstand 320,000 pounds? If I said that right, 100,000-pound truck. The very most it would be 100,000. No one's going to be higher than 100,000. Why do you have to build it for 3.2 times as much? What I didn't know, Alex, is that 1 in 4 U.S. bridges failed in the 1800s before they started applying these principles as much as they have. So it's critical to do that. I already mentioned the debt service coverage ratio. One other example is forecasting occupancy. You think, well, we'll be at 100%. Everybody's going to want to live here. Well, that's just not realistic. There's going to be people who don't pay. There's going to be delinquency. There's going to be people moving in and out. There's going to be vacancy. And even in Austin, Texas, where people said, well, there's not going to be any vacancy there. Well, there's vacancy in Austin, trust me. Yeah. So it's good to not assume rent rates are going to stay at the current margin. People said, well, rents have gone up 9% a year average in Tucson for 5 years. So we'll continue to assume 9% a year. Well, that's not smart. A margin of safety would say, what happens if rents go down? And by the way, they have in some of those places. What happens if you have floating rate debt? What happens if it goes up? There's just a lot of things you need to do in underwriting that would be smart and would not be what a guru would teach you. I was actually at a conference in December 2018 or 2019, and a very, very famous, flashy multifamily guy got on stage. He wasn't even on the agenda. And he said, buy all the multifamily you can. It's always going to go up. That guy's in trouble with his investors right now because, well, I'll leave it at that. Anyway, here's a quiz. Which one would you rather buy? Would you rather buy or invest in investment number 1, which is a total target return of 15%? And here's the breakdown. Income generated by current operations of 11%, and then a target return from theoretical appreciation of 4%. 11 plus 4 is 15. Or would you rather buy into number 2 with a target total return of 20%? Sounds better, right? The breakdown is the income generated by current operations is 3%, and the target theoretical appreciation is 17%, totaling 20. Which one, Alex, do you think most people would probably invest in?
Well, I think most people who are not as informed see that 20% and they jump at that, going for the big return. I personally would rather go for the 15% that already has more stable income and is going to be less risky of an investment.
Yeah, absolutely. And the longer people are around, and one of the benefits of people listening to your podcast is that they learn stuff like that and they realize, hey, wait a minute, I want to go with this sure thing. Have you noticed that super wealthy people, Alex, are not only willing to tolerate, but they seem to even want lower returns? Like, I was pitching some guy like 15 years ago on this amazing high return. And he's like, I just stick with my 7% returns.
Yeah.
Really? Why? Well, now we know why. It's because with more experience, we realize we want to preserve what we have. If someone has $1 billion, they want to make sure they preserve it first. And this is what this type of thinking does. So what are some questions in real estate to make sure you're implementing a margin of safety? And the questions could be, what if cap rates move against us? And they have, by the way. What if interest rates increase fast? And they have, by the way. And we have to refinance in 3 years. What if it takes 6 years instead of 3 to really do the value add? What if a new competitor comes online while we're building and leasing up this self-storage facility? What if lease rates cannot be raised as planned due to a setback in the economy or a pandemic or a war in the Middle East or something? So you've got to think through all those types of things. And I would just recommend that everybody consider applying this to your own real estate investment decisions, whether you're investing passively or actively. So what do you think, Dr. Alex?
I completely agree. I think another place where we saw this and folks not really considering a margin of safety was in short-term rentals. Folks underwriting short-term rentals on 2020, 2021, average daily rates and occupancy when we saw this big spike during the pandemic. And now we're seeing a lot of these folks are either having to leave or sell their home because they aren't able to make the income that they were expecting because the average daily rate's gone down, the occupancy's gone down. Folks are struggling a bit more in terms of having extra cash to go on these vacations. And so a lot of folks underwrote expecting to have those same returns forever going forward. And they definitely got burned from that perspective. And we've seen that in some of our short-term rentals. Luckily, we had enough experience and enough margin of safety there that we're still making great returns, but it's definitely another spot where folks got burned. The other thing too, Paul, that I hadn't really thought about as much was insurance, rising insurance costs. We've really seen that impact how much cash flow we're having on some of our properties, especially a home we have in Florida. I mean, it just every year, we first bought the house back in I think we were paying like $900 a year for insurance. And we just got quoted, this is legitimate, $24,000 on a quote for insurance for a single family house. We're not taking that. We have a bunch of other quotes, but I had to respond back to the insurance agent. I was like, hey, do you mean 2,400? Because I think this is a typo. Yeah. She was like, no, I thought the same thing. But luckily, we were able to find some other quotes around $3,000, but it just brings up a good point. And something that I hadn't thought about was, hey, how dramatically is insurance going to go up? And we're seeing that all over. Yeah. Colorado, lots of hail damage. So we're seeing rates go up here on our properties.
Yeah.
So it's just something to keep in mind as you're getting started. Don't forget the insurance cost and rising insurance costs going forward.
I was just with some investors from Colorado the other day. They were from Denver, and they said that this hail damage in their condo complex had like tripled their insurance or something. It was horrible. And so it's critical that we think about these things. And this is why you don't want to over leverage. That's one thing that Buffett has taught us. Another great quote for real estate investors specifically is, if you don't find a way to make money while you sleep, you'll have to work until you die. So Buffett makes money while he sleeps. How does he do it? Well, he's got 28 people in his corporate headquarters, but he's number 7, last I checked, in the Fortune 500. Think about that. 28 people he manages, and he doesn't even manage them really. But he's got thousands and thousands and tens of thousands of people working. He is like, in my mind, sort of like a fund of funds in real estate. I mean, he takes money from investors and then he invests it in all these deals, but someone else is doing the heavy lifting on those deals all over the country while he's sleeping, while he's awake, while he's on vacation. And this is what real estate is perfectly suited for. Now, I don't think all real estate's perfectly suited for it, because a lot of folks I know, and some of them are doctors, I have to say, they're basically trying to build a single family portfolio. I got pictures. I wish I had my phone with me. I got pictures this evening from an investor who's actually done quite well, but they've held on to a lot of single family rentals in California. And they sent me pictures, the husband and wife, for like 3 days of them painting, hauling trash out of a unit, and all this hard stuff. And then they sent me pictures of their daughter in the south of France. I thought it was funny. But anyway, the point is, real estate could be perfectly suited for it. But my contention, and I think I mentioned this on the show before, my contention is that if you've got a job as a physician making $200,000, $400,000, $800,000 a year, and you've got a family and you've got stress and you've got maybe even a hobby, maybe you play pickleball like me, it's probably not the best use of your time to be going over to clean out a toilet at a rental property, or even having a property manager that does it. I know lots and lots of people do it, but I honestly think that it's harder than people think it will be to manage these properties themselves. And I think that real estate could be perfectly suited, but a lot of people will make money while they sleep by basically investing passively. So that's why I say real estate investors could turn a good night's sleep into a second job if they're not careful. And so I just say here, how do you ensure an uninterrupted night's sleep? Well, we stay in our circle of competence. And Buffett talks a lot about circle of competence. He also talks about a strike zone. In fact, I don't have the time to hit it tonight, but he studied Ted Williams. Ted Williams retired from baseball. He had an incredibly high batting average. I think it was like 400. I don't know if it ended up for his whole career there. But he basically said he had a strike zone. He had 96 places a ball could be pitched. And he decided that he would only have a handful that he would ever swing at. And Buffett says investing is a no-count game. You don't have to swing ever. You can stand there for 1,000 pitches with the bat on your shoulder and just let them go by. And that's Buffett's strike zone, Buffett's circle of competence, if you will, is to really, really be good at a few things and let everything else pass by. In fact, Charlie Munger, God rest his soul, said that we have 3 boxes in the Berkshire Hathaway offices. There's in, out, and too hard. And he said, if it's too hard, we're not going to mess with it. And that's what I fear for a lot of real estate investors. They take on things that are too hard in their, quote, spare time. And they end up spending a lot of their weekends, evenings, time off, vacation, spare lunch breaks, chasing another deal. And you don't have to. You can invest passively. And that's just my thought. What are your thoughts on that, Alex? Maybe I ruffled some feathers, maybe even your feathers there. What do you think?
No, my feathers are not ruffled at all. I just had this conversation yesterday, actually, with a friend. It was really cool. She was on faculty when I was in residency at Eglin. Megan, if you're listening, thanks for listening. But we just had a really great conversation, and she really wants to get started investing in real estate. She's a mom. She's an OBGYN. She's working a lot. And she's like, well, I think I want to buy a short-term rental and manage that. The cash cash flow is great. I think it's going to be a great opportunity, but I'm also interested in syndications. And she's still trying to figure out what she thinks will work best for her. But I just reinforced to her, like, hey, what's the most valuable use of her time? What do you enjoy the most when you're not working? And she's like, oh, I love spending time with my spouse and with my son, and I want to be there for him. And I'm like, well, then an Airbnb is probably not the best option for you. And I talked to her about some of our short-term rental experience that we've had, and the things break always at the worst time. It's on Christmas Eve when you're at Christmas dinner. It's Thanksgiving. It's never a good time. And so it's okay to invest in a syndication and great opportunities. And I think they really are probably the best opportunities for physicians who are busy, who are working full time, who want to focus on spending time with their family. It's a great way to learn real estate. It's a great way to experience different asset classes and invest with incredible people like yourself. I do think, though, that you are giving up a little bit of control and you're giving up a little bit of cash flow.
Oh, yeah,
and it's a spectrum.
Sure.
And that's what I told her. I said, cash flow is a spectrum of the more active an investment is, the more cash flow you have the opportunity to obtain, but the more passive something is, potentially the less cash flow that you have in that regard. And you need to think about what matters most to you. And another thing I think physicians don't think about sometimes is what's the value of that hour? What's the value of that free time you have with your family?
Yeah.
And are you willing to give that up to go paint your unit in California or not? Or would you rather be in the south of France with your daughter, as you mentioned? And so I think it's something to think about. And I've definitely been thinking about it a lot more as we still are investing very actively. I've started investing in some syndications, and tell you what, Paul, it feels good to just get a direct deposit right into the bank account and not having done anything other than analyze the deal, attended a couple webinars, and wire over some cash.
We think about the 80-20 rule, or the even 80-20 of the 80-20, which is the top 4% of the syndicators can potentially produce the top 20% of the top 20% can produce the top 20%. Sorry, the top 80% of the top 80%, in other words, the top 64% of the results. Mm-hmm. And if that's true, there's a skew curve that represents that. And the skew curve basically says that the results of those top few percent are much, much higher than the average, like 3, 4, 5 times higher. And so that's true that's proven statistically in a lot of different arenas. That's, of course, the Pareto principle. So I said that Buffett arguably had the most famous saying. This is arguably his other most famous saying. The first rule of an investment is don't lose money. And the second rule of the investment is don't forget the first rule. I'm going to fly through this one because I have another one I want to get to before we're done. So I don't know if you remember, in the fall of 1963, I was actually almost born. And Warren Buffett invested in American Express during this thing called the salad oil scandal. And you can go Google it. It's kind of a crazy story. But American Express, of all people, got involved in this huge scandal. And this guy had been making like 100% profits in a short time, but he actually had lied to everybody. And so American Express's stock went down horribly. Now, Buffett was a young guy. Let me think. I think he was 3. Buffett invested heavily because he realized this is a short-term thing. This is in the headlines now, but it won't be in the headlines for long. And by the way, John F. Kennedy was killed a few weeks later, and it was out of the headlines. And like American Express, I don't know if it doubled, but it went back to normal in a very short time. And he made a whole lot of money. He realized that buying American Express stock at a much, much lower amount basically created a huge margin of safety because it was so low, and it was historically low, that this margin of safety that it created just gave him a whole lot of room to make money. And he did make money. Here's 3 questions to ask yourself when you're thinking about investing in a real estate investment. The rookie investor asks the first one, what's the upside? An experienced investor asks the second one, what's the downside? A professional asks, can I live with that downside? And so really important to consider that, really important that I believe that value add real estate can create a higher margin of safety. and can create a greater opportunity not to lose money. And I'm not going to spend a ton of time on that, but basically value add real estate basically goes in, like, here's an example. We invested in a self-storage facility in Las Vegas, and the rents, this was a mom and pop owner who had built this facility in 1982 when I was a senior in high school. And she still owned it in 2023. And she had homeless people living in the units, which is illegal. She was charging $48 a unit for a 10 by 10 unit. And she wasn't full. She had terrible marketing. And we were the largest investor in this. We are the largest investor. And get this, it was acquired, and the rents, the going rate for those 10 by 10 units was not $48 a unit. It was $160.
Wow.
And so my operating partner got in there, cleaned it up, gently moved the homeless people out, and put some nice signs and websites and did some marketing, and voila, the place is worth way over double what it was a year ago, because real estate is based on the net operating income. It's hard to lose money when you buy at a value like that. And again, I told you earlier, Buffett said, price is what you pay, value is what you get. And that's why I love value add real estate. Any thoughts on that?
No, that's great. I completely agree. That margin of safety is important. I love hearing that Las Vegas story, and I know you have a lot more like that where you guys were able to add just a lot of value. And so I think folks might be listening to this and be thinking about, like, well, I can't go buy a huge self-storage facility right now, but you could buy that house down the street that's all beat up that you can renovate and fix up and create that value add opportunity there as well. So that's fantastic, Paul. Completely agree.
And taking low debt is part of the picture there. Here's another quick example. We invested in a self-storage in Texas, and it was acquired for $2.4 million cash. 4 months later, it was appraised at $4.6 million after doing a lot of cleanup.
Wow.
Now, at that time, my operating partner took $2 million in debt on that property. If he had $2 million in debt on the $2.4 million purchase, that'd have been 83% leverage. But he took $2 million on a $4.6 million property, which was only 43% leverage. And then if things went really south, or if there was a pandemic or something horrible, well, he still has a huge margin of safety and therefore doesn't lose money. So it's getting a little bit late, but do we have time for one more, Alex?
Absolutely, Paul. I would love to hear another one.
All right. So last, let's talk about creating a moat. A truly great business must have an enduring moat that protects excellent returns on invested capital. Well, who would have thought? Buffett's first failure was he was about 23 years old. It was 1952 or 53. And Buffett bought a filling station. It was I can't remember the type, but it was in Omaha, Nebraska. And he and his partner did everything right, as you can imagine. But they watched cars streaming in and out of the Texaco station across the street, while Buffett and his buddy rearranged wiper blades and swept the floor, and they lost money on that deal. What he realized is the guy across the street had an incredible moat around his business, and that moat was he was incredibly friendly. He called everybody by their first name, and people realized that they're not going to come over here to some punk kids when they've always loved the guy across the street. And so Buffett now realizes that's exactly what you need. And there's so many examples of the moats that Buffett has set up. But think about you in your life. What can you set up? Well, we like to partner with multifamily operators, syndicators, who use something called Apartment Life. Apartment Life is an organization that actually puts effectively a chaplain at these different properties. And that chaplain builds community. They have movie nights. They have popcorn and movies. They make backpacks for the kids. They actually go out and pick up the person if they need a ride to their car breaks down. There's lots of ways to create these types of moats around your real estate business. It could be having amenities that nobody else has it, so they will never leave. Like, what if you had extra room on your property? You couldn't get approved for more apartments, but you could put some self-storage in. Or what if you had an RV and boat parking lot in the back for people who needed that? Or all kinds of different things you could do. So think about how you can create moats. Think about how you can create moats, not just in your business, though, in your personal life as well. And I want to land the plane on this. I had a friend who, his name, well, I won't say it, but he wouldn't mind if I did, honestly. But he told me, man, I got to slow down. I'm traveling all over the world. I'm flying to Africa. I'm flying to Europe. I'm so busy, but I've got so much success. One day he called me and he sounded really down. So I went over there and I sat while he was crying with his head in his hands. He said, I got home from New York City last night just in time to see the U-Haul pulling out of my driveway. My wife left a note and she said, I'm done. I've warned you and warned you for years. I begged you to go to counseling. You wouldn't do it. And his wife had a bunch of new friends that he didn't even know that were loading up that U-Haul right when he pulled in the driveway, and they took off. And he's never seen her again. And he didn't build a moat around his marriage. He didn't build a moat around his personal life. He didn't build a margin of safety to spend time with his wife. I just want to really encourage people. I don't want to end on a down note, but I just want to encourage people to really think about how you can create moats and margins of safety in your personal life, with your family, in your business, with your kids, with your friendships, with your health, your exercise. What are you doing to create moats so that, and it turned out, by the way, that some other guy had swept his wife off her feet. She was in medical school, and some guy in medical school was actually one of the guys in the U-Haul, and he did not create a moat around his personal life. He's very aware of this now, but it was very painful. Alex, any final thoughts on that? That's where I'm wrapping up.
Yeah, no, that's great. And I think it's super important for folks to hear that. It's easy in medicine to get wrapped up in seeing more and more patients and doing more and more things. And it's hard, especially for new physicians coming out of residency, to realize that you have to have some semblance of balance and you have to prioritize the things that matter most. And I've said it before, and I'll say it again here. The only people who are going to care that you stayed late seeing another patient or working on your notes or doing more administrative work, the only people who are going to care is going to be your spouse and your kids. They're the only people that are going to remember. The patients aren't going to remember. The administrators aren't going to remember. No one else is going to remember but your kid is, and your spouse is going to remember that. But it's really important. And I think gets lost sometimes because it is a noble job and a noble profession that we have, but we have to remember the folks that matter most and the folks that are going to be in our lives when we're done practicing medicine.
Right. Yeah. So easy to take advantage or just to, just not think that way. And then until it's too late. Mm-hmm. I mean, we all know of wealthy people who made a lot of money and their kids ended up. Well, Elon Musk is a famous example. He's got 11 kids and a lot of them won't even speak to him.
Yeah. It goes back to that saying that a healthy person wants many things, but a sick person only wants one thing, and that is to be well. And so I think it relates here as well. Paul, this was so great. Definitely a unique take on Warren Buffett and his philosophy and his quotes. And I think so much value that can be added not only in real estate, but also in personal life and professional life, and so many things that we can learn from Warren Buffett. I have his memoir, Snowball, that is, I think it's close to 1,000 pages that I have not yet read. And this is definitely inspiring me to add that further up my list of books. I just need that 80% of my day time to it. But absolutely, this is great.
I did Snowball 36 hours, if I recall, on Audible, and it was fabulous.
That's awesome. That'll be my read during paternity leave coming up once new baby boy Shlo comes along in a couple months.
That'd be fantastic. For those who can see this is Buffett's Strike Zone. My daughter drew this, and I think it's pretty cool. Yeah. It's him with dollar bills falling out of his pocket in the strike zone. And basically, this is the Ted Williams strike zone, and kind of a fun little example.
That's fantastic. Well, Paul, thank you so much. Where can folks reach out to you if they want to learn more, if they want to invest in a deal with you guys over at Wellings Capital?
Yeah, they can reach out to me directly, Paul, Paul, at wellingscapital.com. That's WELLINGS, Paul at wellingscapital.com. Or they can just go to that website, wellingscapital.com, to learn more. We've got some special reports. You can get those, like free special reports on investing in RV parks, self-storage, mobile home parks. I've got some books. You can get those at wellingscapital.com/resources.
That's awesome. We'll be sure to put those resources in the show notes as well, and how folks can reach out to you. Paul, thanks again for your time. Thanks for an incredible presentation. I love every opportunity I get to talk with you and learn from you, so I really appreciate it.
Thanks, Alex. It was a real honor to be here again. Awesome. Have a great evening.
Thanks, Paul. Have a good one. And with that, it's been Paul Moore and Dr. Alex Schlow with another episode of the Physicians and Properties Podcast, signing off.
Hey, real quick, if you're still listening to this, I'm assuming you got value from it. So I need your help specifically. My 2-year vision with this podcast is to help 100,000 physicians learn how investing in real estate can give you the freedom to practice medicine and live life how you want. There are 2 main ways that a podcast grows. One is through ratings and reviews, and the other is word of mouth. If you can please leave me a 5-star rating and review on Apple Podcasts and Spotify, as well as send this to 1 to 2 friends that you think would get value from it, we can reach the physicians that we want to reach. Thanks in advance, and talk to you on the next episode. Please note that the information shared on this podcast is for informational purposes only. It should not be considered financial or medical advice. The views expressed on this podcast are those of the host and the guest and do not necessarily reflect the views of the Department of Defense or the United States Air Force.